Right, can you see my screen, right?
Yep.
Okay, hey guys, welcome back for our today Philip Trading Podcast, and I'm your host for today. My name is Casey, and I'm a dealer here at Philip Capital. So now, before we start, please take note that this presentation has not been reviewed by the Securities Commission Malaysia and is for general educational purpose only. It is not an invitation to buy or sell any investment products. Hence, the speaker and PCSB are not liable for any financial decisions you may make based on the contents of these presentations. With us today is an extremely experienced speaker, Lawrence. How are you today, Lawrence?
Yeah, I'm good. Thank you.
Okay, so now before we start, let me just bring you through a quick introduction to our esteemed speaker for today, Lawrence Lee. Lawrence is currently the Chief Investment Officer at Continent Alpha Wealth Management, which is an independent asset management firm. It develops and oversees the overall investment platform, representing the firm's investment views, strategies, and all related investment product and solution to relationship manager and ultra high net worth clients. Prior to Continent Alpha, Lawrence was a CIO at another EAM for 5 years, and he is managing US $4 billion of AUM. So Lawrence now has 15 years of experience across major asset classes with fund management experience in both the private wealth and institutional space. Lawrence has also worked at UOB Global Market Division, where he co-managed a US $8 billion global fixed income portfolio, and now he also earned honor degree in economics from the National University of Singapore. In addition, he is a CFA charter holder and a certified financial risk manager. So what an interesting speaker we have with us today. Well, I won't hold too much for your time. So let's get straight into the content. So up onto you, Lawrence. Right.
You have to let me. Okay.
Yeah, yeah, right.
Yeah. Hi, everybody. So today's podcast is like a precursor to the webinar that we will have on CME futures on the 12th of June. So before we start, a little bit of disclaimer and disclosure. This is not meant to be investment advice nor product recommendation. So to understand, futures, we must first understand that futures is a form of derivative and it derives its value from the underlying instrument, which is actually interest rate. So it is very important for all of us to understand what is interest rate and why is it important? How does it affect us? So interest rate affects a lot of different parts of the economy. At the individual level, it affects our spending decision because it affects the saving rates on the deposits you get paid at the bank. It affects the housing loan rate and the car loan rate. So typically, when interest rate is higher, it means the cost of borrowing money is higher, and it actually affects the individual propensity and ability to spend. Even for corporation, the business decision to invest in either hiring or capital expenditure is also affected by the cost of borrowing money. Even for government also would need to issue bond bills to borrow money so as to allow them to spend on public infrastructure project or insurance, Medicare, etc. And for financial asset, typically a higher interest rate will affect the valuation, will negatively affect the valuation because of the discounting. Usually, high interest rate means future cash flow is discounted more negatively. So if we look back in 2022, when the Fed hiked interest rate all the way to above 5%, equity market actually had a very big drawdown. And lastly, in terms of currency, typically a higher interest bearing country would see its currency appreciate relative to a currency with a lower interest rate because of uh, interest rate arbitrage and also the flow of hot money. So we can see that interest rate is actually a very, very important component. And to understand interest rate, we must also understand what is the Fed. The Fed is actually the US central bank, and he has a dual mandate. And what is popularly known as dual mandate would be number one, to achieve maximum employment or growth, and also to maintain price stability. And the US Fed has actually three key entities: the Federal Reserve Board of Governors, 12 Federal Reserve Bank, and also the Federal Open Market Committee, otherwise also known as the FOMC. So the FOMC holds 8 regularly scheduled meetings a year, and the next one will be coming up in a fortnight on the 18th of June, which they are expected probably not to cut rate or high rate, but just to hold interest rate steady for the upcoming meeting. So why is the US Fed so important to investors and to the global economy? For two simple reasons. Number one, the US dollar, as we all know, is the reserve currency of the world. Until lately, there's a lot of debate whether the US dollar strength can be maintained, or we're going to see a downtrend of US dollar weakness because of whatever is going on with Trump and his tariff. And number two, the US is the biggest economy in the world. So people always focus on the US Fed for these two reasons. If you look at the diagram, is how the whole Fed policy transmission mechanism works. So typically, the FOMC will set a target range for the Fed fund rate. Then they'll implement the policy. Either a hawkish Fed policy means they can hike interest rate, or a dovish Fed policy means they can cut interest rate. And this ultimately affects the market interest rate and also market's expectation of future interest rate. And this will have an impact on overall financial condition, because the consumer, corporations, and producer decisions are all affected by interest rate, which is the cost of borrowing money. And this has an effect on the Fed's progress towards achieving maximum employment and price stability, which is their dual mandate. So it has been very well documented that since 2nd April, which is Trump's Liberation Day, where he imposed reciprocal tariff only to pause it for 90 days, that the US 10-year Treasury yields have been very volatile. We can see from the diagram itself that since Liberation Day, 10-year Treasury yields actually collapsed all the way to below 4% because market was expecting a recession and for the Fed to cut interest rate. However, the rally quickly reversed itself. There was weak Treasury auction. There were fears that tariff would cause inflation to persist and also, worsen the US fiscal deficit issue. So much so that Treasury yields skyrocketed in a matter of days and weeks, all the way back to 4.5%. And since then, it has been very volatile, trading more like an emerging market debt rather than the benchmark bond of the reserve currency of the world. And it's also important to note that US public debt has hit a very alarming level of 36 trillion. And this is widely perceived to be a very unsustainable path. Debt to GDP is now more than 100%. And in 2024, US actually spent 880 billion on net interest payment alone. And this is the first time this net interest payment amount has surpassed expenses on Medicare and defense. So it is gaining a lot of attention lately, and it's also the reason why there's so much pressure on the long end interest rate in the US, because people are naturally concerned that US might not be able to, fulfill its debt obligation. And 2 weeks ago, Moody's has also downgraded US from AAA to AA. So there is a lot of concern and talk about this fiscal sustainability of the United States. On the macro front, if we look at the CPI, it is quite encouraging. You can see the year-on-year US core PCE, represented by the green line, is approaching the Fed's target of 2%. So it is encouraging that if there's progress on the inflation front, the Fed could actually cut interest rate. However, there's also a camp that is worried that tariff 2.0, which is what we are witnessing now, might bring back inflation in the 1980s style. So if you look at the dark blue line on this chart, it actually shows the inflation picture from 1965 to 1985. As we all know, in the 70s, the US actually cut interest rate only for inflation to spiral yet again, and Paul Volcker was forced to bring interest rate back up again in 1980 to combat inflation. So if we overlay the inflation situation from 2013 all the way to now, you can see that the charts are very eerily similar. So there is a worry that with what we are witnessing with the tariff, that we might see a comeback of inflation. And if that was to happen, the Fed probably will not be able to cut interest rate as much as the market expect them to. And on the macro front, the US consumer are also turning very negative and stagflationary. So stagflation is a situation where we see a sharp slowdown, a recession, but inflation is still very high. That is stagflation, and it's the situation that the Fed would not want to see the most. But lately, the US consumer have turned very bearish. You can see consumer sentiment dropping very rapidly, and also inflation expectation, which is what consumer expect inflation to be in 5 to 10 years time, actually going higher. So it is not a very good sign. And with all these things happening in the macro picture, the US rate cut pricing have also been very volatile. So this rate cut pricing is what market expect the Fed to do, and it's actually reflected by certain interest rate derivative instrument. And 3 months ago, you can see that market was expecting about 80 basis point of cut by the end of 2025. So typically, if we assume the Fed to be moving every meeting by 25 basis point, then 80 basis point is about three times of rate cut this year. But if you look at the current market pricing, it's factoring only about 60 basis point. That means it's slightly more than 2 cuts. It means that market do not think the Fed will cut so much this time by the end of this year. Rather, the Fed cut pricing have been pushed out to 2026 because of the uncertainty about inflation. And the Fed has also come out and said, because of the uncertainty of the impact of tariffs on inflation, they would rather wait and see rather than cutting rates prematurely only to hike them up later. So you can see this is the graph of the Fed fund rate, and in 2021, when US inflation went above 9%, the Fed was forced in April 2022 to actually hike interest rate all the way up by 5 percentage points to combat inflation. Then inflation started coming off, and last September, they were relatively confident it was progressing towards their dual mandate of price stability and maximum employment, that they started to bring interest rate down. However, now with tariff, they have become more uncertain and have adopted a wait and see approach. So you can see that market is still expecting the Fed to cut interest rate, but not as much as 3 months ago. But the dark orange line is the Fed's own projection of where they think interest rate will be, and they will be producing and updating the latest dot projection in the June FOMC meeting. And we can see whether they will be more divergent from the market then, or they'll be more aligned with what market is expecting them to do. So a quick introduction to the US Treasury market. It is the largest and most liquid interest rate and bond market in the world. There's 36 trillion of total outstanding issuance now, and they are issued via auctions on primary market, and they can be bought and sold via trading in the secondary market. And for a long period of time, until recently, US Treasuries have always been deemed as a safe haven or flight to quality instrument, meaning if we see like events like war, Russia-Ukraine war, or the stock market meltdown, usually people will flock and buy US Treasuries, thinking that the Fed will cut interest rate. And because back then, US Treasury are triple A instruments, so people view it as a safe haven instrument. But lately, that has come under question, and for all the reasons I mentioned earlier. But other than that, US Treasuries is very liquid, and it is a safe haven instrument. Yep. So there's also something known as the term structure of interest rate. It basically is known as a yield curve, which is a similar quality bond but at different maturity. So you have 2-year, 5-year, 10-year, 30-year bond, and then you join up the interest rate across maturity, and you get a yield curve. So yield curve can typically be upward sloping, downward sloping, or flat. So last year when I did this presentation, June 2024, that was before they cut interest rate in September. You can see that the curve was actually inverted, meaning the front end interest rate was higher than the back end. Fast forward 1 year, you can see this whole yield curve shape dramatically changing. They have now brought front end interest rate all the way down to 4%. And now the long end interest rate, that means from 10-year all the way up to 30 years, the interest rate have gone higher because of worries about inflation and the fiscal deficit situation. So you can see this yield curve can dramatically change very, very quickly, depending on market expectation of fiscal situation and also the monetary policy condition. And during the webinar, I will also be giving examples on how you can use yield futures to express a view in the change of the yield curve itself. So Treasury futures, there are three main users. If you are a holder of bond, you have a lot of bonds in your portfolio, you can actually, and you're worried about interest rate going higher, you can use Treasury futures to very effectively adjust your portfolio duration by selling futures to hedge the duration risk if you think that interest rate is going higher. Or you can simply use it as a very quick and fast way to express a directional view, either to buy or to sell as a bet on interest rate itself. Or you can actually, like I mentioned earlier, you can use it to express a curve trade, which is flattener or steepener, something that I will also go through in the webinar itself. So to understand why yield futures are attractive, we must first go back and understand the evolution of Treasury futures. So there is something called the US Treasury Futures Classic, and this is what institutions typically trade. They are standard size, so they are huge, they are big, they are liquid, because they are meant for pension funds, insurance funds, banks. When I used to trade for a bank, I used to trade these classic Treasury futures. So they are different maturity, 2-year, 3-year, all the way up to ultra, which is 30-year. And importantly, they trade in fractions. They trade in 30 seconds. And they trade in price term. So because the size are standard, it may not be so friendly for retail to trade. So CME actually introduced something called a micro treasury futures, which is actually similar in all aspects except for three main differences. Number one, they are cash settled, so you don't need to worry about the physical settlement of the classic treasury futures. And number two, they are only available in 10 and 30 year, and not in 2-year, 3-year, 5 years. So only in the long end maturity, they are available. And lastly, everything is the same, except that they are 1/10 the size of the Treasury Futures Classic. So they are more friendly for retail. However, because they trade in price term, but we commonly think about interest rate in yield terms, it is sometimes still not so intuitive. And so CME has actually launched a new product, which is our focus, called the CME yield futures. And they have 5 advantages. Number one, they trade in terms of yield rather than price. So you don't need to keep thinking of the opposite direction when you want to express a view. And similar to the micro treasury futures, they are cash settled, so you don't have to worry about the operational risk of failed settlement, etc. Number three, they are very small size also, so you can actually trade very granular sizes and denomination, so it's friendly for retail. And there's no basket of delivery securities, something that I will go through in the webinar in detail. They just follow a single on the run, so it's a lot cleaner, a lot simpler. And most importantly, they have a constant risk exposure. It's only fixed DV01 regardless of maturity. This is also something I will explain in detail during the webinar as to why CME futures is very friendly for retail, and it's very easy to express your view because of this constant DV01 regardless of maturity. And this is the last slide. This is all the various advantages of the yield futures. Is actually when we compare against the classic treasury futures, and I will also go through in detail during the webinar itself. So, yep, hope to see all of you during the webinar on the 12th.
Wow, that was such an insightful session from Lawrence. So thank you, Lawrence, for the insights on the trading treasury markets on CME. For those that are interested to know more, you can join Lawrence's full-length live webinar on the same topic on June 12th, Thursday, 8 p.m. to 9 p.m. Also, you can utilize the insight shared by Lawrence by gaining exposure to the CME markets with Philip Capital for as low as $4. For more information, kindly visit our website at philip.com.my. Thank you all for tuning in, and thank you, Lawrence, for your time. Yeah. So that's all for today.
Thank you.